I think that trading is something that is often misrepresented as being easy, as being a fast path to riches. And the reality is, there's a lot of effort you have to put forth to become consistent at this game. So, my recommendation to everyone out there is tune out the noise that says this is easy, because it's going to set your expectations in a way that doesn't calibrate them for the effort necessary for most people to succeed. And if you do set your expectations properly, you can avoid the fourth shape. Everyone wants to avoid the fourth shape. Some don't. Some have to kind of experience this as a part of their journey in learning how to manage risk. But I'll tell you right now, the only thing they're really taking home, the people that have blown their account, is that risk management matters. So if you can simply wrap your head around the idea of don't lever up too much, don't concentrate too much, your barometer can be something very simple like, hey, am I constantly fixated on this screen? If you're constantly watching your trades, you're in too much. If you're having trouble sleeping at night, you're in too much. And being in too much can really hurt, because if you're too concentrated, if you're too leveraged, a drawdown can be extraordinarily hard to recover from. So that's the point. You manage your risk because you really need to make sure that you run your trading like a business. You're capturing the spread repeatedly, and that's the goal, right? You're buying and selling inventory. You don't have to dress it up as something sexier than it is. Quite frankly, you're running a business, treat it like a business, stay well capitalized so you can continue to trade. Bit about me, I'm not new to this game. I didn't start during COVID. Been trading for about 21 years now. And so I'm approaching this a little bit differently. I really do think, and if you've been trading for a while, or once you have, you'll come to appreciate this. The most important thing to understand and embrace is when not to trade. It's really about trying to reduce that impulse to always be involved in the market. You've got to figure out what setups work for the asset you're trading and work for your way of trading it, and then only trade those setups. That's the way. Like, if you're going to look at this from the perspective of how do I survive this crazy game where 95% of people fail, and it is that bad, the statistics are against us as traders. But I don't believe that that statistic dooms us. I believe it actually gives us an opportunity to reveal the why behind it. Why do only 5% of people, consistently make money trading? Because they're the 5% that become more systematic, that become more proficient at managing their risk, that become more, I would say, disciplined about how they trade, what trades they're putting on. And as a result, they build confidence in their self. They build confidence in their system. They have the discipline to journal their trades, go back, review those journal trades, and learn what's working and what's not working, leaning into what's working, but figuring out the problems along the way as well. Because if you're not using a system that you've built, if you get into the market and the market opens and everything's trading and all the rules and all the discipline just fall to the wayside, that's not a strategy. A strategy is something you're actually practicing. It's not just a bunch of good sounding notes on your wall or sticky notes on your screen. It's actually identifying signals for entry that help you understand where your exit would be and where your risk threshold would be. For me, ideally, the reward on a setup like that is going to be 2-to-1 versus the risk. That already sounds compelling to me. If it's 1-to-1, the same risk to reward, it's basically a coin toss. What's the point of a trade like that? Put the odds in your favor. It also keeps you out of trouble, keeps you out of over trading if you can be more systematic and disciplined about your approach. So enough lecturing from me. Let's go into the big picture. First, we all know the market we're in right now, right? This is it right here on screen. I know this fear gauge has not changed much since April 23rd, but it literally has been stuck right around here in the LFG area. This is my remake of the CNN fear greed gauge. Eventually, we'll probably get into panic buying as it's measured by this particular indicator, but in some other areas, you could argue we're already there. But first, let's go through the good news, because there are some very interesting trends playing out that are supporting this AI-driven rally in the broader market. First, data center power demand is about to go parabolic. This is something we've been talking about for years. We're really starting to see it ratchet up even more. And this has everything to do with the amount of data centers that are out there. So if you're looking at, for example, the possibility of where do I invest in this AI boom? Well, we have opportunities in utilities. We have opportunities in Dr. Copper and its miners. We have opportunities in companies that make components for electronics like transformers. All that infrastructure needs to be built out. So even in the periphery of the AI boom, there are still opportunities up the supply chain. And they aren't all NVIDIA or Broadcom, believe it or not. The other part of the AI race is the agentification of interaction. And that sounds like a lot of fancy buzzwords because it is. Let's break it down. So, agents are, if you're not familiar, basically an application that you use to interface with a large language model. So you might be using an agent like Claude Code or Codex, or you may have heard of Hermes recently, or Factory Droid or OpenCode. These are all essentially layers that tap in to a model. Why is that important? Because essentially they magnify the amount of interaction. So you can see on this chart, we're looking at when agents come online and really start to become a bigger part of how we're interacting with AI, those tokens are set to surge both for individuals and for enterprises. That's likely a reasonable assumption. Having used agents myself quite a bit, I can say that they definitely streamline a lot of the workflow because instead of having to go line by line, you're going to have something that you can set on a set of parameters that define a mission, and it has to validate the work product to be done with that mission. That means you could essentially have a swarm of agents, each with their own specializations and tasks, running on, say, creating a scaffolding for a program overnight, wake up in the morning and be able to review the verified results. That's pretty cool, but it also means you've got more potential for automation, more runs that are happening without direct human interaction, and thus you have this ramp in token usage. This has also led to a really large ramp in exports from Taiwan and semiconductor demand in general, as we've seen with semiconductor stocks and the Kospi, which is largely a semiconductor stock index at this point, going parabolic. So we can see it's also rather cyclical, isn't it? We got these big ups, these big downs. That's something to keep in mind with semiconductors. When the times are good, they're really good. But when this cyclical sector rolls over, it can get pretty nasty. So that's just something to keep in the back of your head. I don't know that we're there yet, but I think that we're certainly seeing a lot of concentration risk in the sector so that if anything was to, let's say, change the narrative, maybe problems with the ability to get all the materials to manufacture these things in a timely manner, that could be problematic. Now, shifting gears a little bit, the S&P 500 looks a lot different when you net out AI stocks. Excluding AI stocks over the last 2 years, the S&P 500 would be up just 16%, which isn't bad. 16%, 2 years, hey, that's not terrible. But when you include those AI stocks over the same time frame, the S&P 500 is up 42%. And in fact, if you look at the chart, you can see that basically the non-AI stock having S&P 500 would be where it was in November of 2024, essentially, right now. So it really is the AI narrative that's pulling this market higher. You can see it in the breadth, you can see it in the individual performance, and you can also see it in the earnings. This is not just without reason. These companies are really growing very quickly. Now, on the other side of it, the risk manager in me, and we talked about the importance of managing risk in the intro, looks at a chart like this and gets just a little bit concerned. This is a chart of the S&P 500 index call and put buying. We're looking at it purely in volume terms. The spread between calls and puts suggests there is a chase, and this is a market that is much more concerned about not missing upside than protecting against downside. To put it another way, I've been talking on these sessions earlier this year about how well hedged the market was when we were going into the war and during the, sort of the introduction to the war with Iran. And this was one of the reasons the market appeared to be Teflon. It couldn't go down. Well, it was because everyone had fire insurance. They weren't really concerned about a little smoke in the building. Now we have the exact opposite scenario. Everyone's long in size, especially in the really hot sectors. And again, this can go on, but we need to at least be aware that this is a different dynamic. So if there was a powerful negative catalyst, it could have a more meaningful effect than in a well-hedged market. Seen another way, this is SPX call skew versus SPX put skew. This just gives you a sense as to how diametrically opposed the positioning is. Everyone wants to be long. No one's particularly concerned about downside. And this is a real jaw-dropping chart. This is SPX total call volume in dollar notional terms. Last week, we traded the most ever, 2.6 trillion in a single day. Imagine that for a moment. That's a very tail wagging the dog scenario. Options absolutely control this market more than I think they've been given any kind of credit for. I mean, this chart shows you exactly what's going on. And, over at the Trader A Discord, we're watching this flow intraday every single day, and we see it. We've even got tools to identify it, and it gives us targets as to where to put our trades. And we keep asking ourselves, when is this system going to stop working? It doesn't work every day, but it works pretty consistently. And we're just like, when are options not going to be the place that you look to find your price target and to understand where the market's likely going? We've been asking ourselves that question for almost 4 years now. It just keeps building. And you can see during that same time period, they've only become a larger amount of the flow. This matters because more and more options are the biggest weighting in what's driving S&P futures price discovery, single stock price discovery. And as a result, we have to look more and more at the options flow and positioning to define directionality and key levels of support and resistance. Now, this is also not a particularly cheap market. If we look at the Shiller-Cape ratio, we're close to levels that we haven't seen since the dot-com boom. That, again, isn't in a nutshell an imminent disaster risk indicator. It just gives us a sense the market is frothy here. Okay, so we know we're in a frothy market. That means, for me, I'm not going to run the sort of leverage I would if we were really well hedged and there was a lot of stuff that was being hate sold into oblivion. Those types of dynamics, either one or both, are much more attractive for me to want to start levering up in on signs of a reversal than a market that is getting very stratospherically valued and very concentrated. In that type of a market, I'm more likely to want to take profits. Now, let's look at the Strait of Hormuz traffic. This is not looking good. And unfortunately, it hasn't really come off the lows here. It really just fell right off a cliff and never recovered. And now we've got signs that there's more complications. Trump rejected the sort of peace deal offer. Iran wanted to keep their ability to enrich uranium. That was seen as unacceptable. And so we kind of hit the reset button on progress. Now there's apparently submarines in the strait. Iran's taking control of the internet cables. If anything, this conflict has made things materially worse in terms of the ability to get supplies through the Strait of Hormuz. This is going to have an impact on global fertilizers. It's going to have an impact on the availability of fuel. Shortages could happen really later this month or early next as global fuel reserves start to drop down. By the way, that's pretty bullish for the price of oil overall. Not great for the broader markets if we see oil hanging out in the triple digits for too long, especially if it starts to rise with any kind of momentum. On the other side of it, the most hated trade in the world remains software. No one wants to have a part of it. AI has absolutely killed it dead. You hear it every day on Twitter. This AI startup or that AI startup has completely obliterated SaaS as we know it. It will never come back. Obviously, that's hyperbolic. I do think there are companies within that space. It's not going to be all of them. There's going to be actual disruption, but the ones with stickier ecosystems, I think, can survive and eventually thrive. I'd be looking at companies like Intuit, Palantir, Cloudflare as examples of that, but I don't think we're out of the woods quite yet. And then the semiconductors also don't look particularly cheap here. If you take a look at this chart, you can see they are trading at an exorbitant PE ratio and price to book ratio, which again, doesn't tell us that imminently anything bad has to happen. It just gives us a sense there's some nosebleed valuations going on in the space. And I think Intel is the one really leading this now with the rally it's had. And hey, maybe it'll grow into its valuation. It's doing deals with Apple, maybe Tesla and others. But for now, until that's really materialized, some degree of at least caution is warranted with things looking this frothy. On the other hand, emerging markets look relatively cheap in comparison. And one of the emerging markets we've liked this year so far has been Brazil, and it's treated us pretty well. I do think we're going to have opportunities in some of the other emerging markets. And I think that it's probably going to be something where we see allocations into areas that are beneficiaries of this sort of reshuffling of the deck in terms of global trade. So if we're going to get better terms with China, even though China's not technically a global an emerging market, it's in a lot of those indices. I think that if there's any kind of progress with the US and China over that meeting between Xi and Trump, that could be a positive catalyst for the Chinese stocks, and particularly the Chinese tech stocks, which have yet to catch up with their US peers. Speaking of the US, though, going back, market breadth remains really, really, really low. So again, handful of names leading this market. That's fine. It can work, but it does concentrate the risk. So if anything should happen to that wonderful generative AI growth narrative that we like so much, that's where the risk gets amplified. That's the sort of tail fattener that we need to watch out for. Now let's shift gears to technicals and momentum. First, we've got our weekly pivots. And basically, the pivots are programmatically generated. They're based on a number of different areas of market generated information, from the order flow, from the volume profile, from options. And so basically, it's as simple as if we're above them, I'm bullish of that asset. If we're below them, I'm bearish of that asset on a swing time frame. And first, S&P 500 futures. We talked about this 2 weeks ago during my last stream. For above the 8-day EMA, there's no reason to be bearish of this thing. This is a very sharp move off the lows, but as long as momentum favors the bulls, there's no reason to take the other side. We identified risks, but we haven't seen it show up in the tape yet. We have to respect the tape. We can't just try to get too smart and too cute, or there's going to be all kinds of things on that wall of worry we're climbing that could get us wanting to fade this market and put us into a situation where we're in trouble. So if we're trading and we're looking at the macro, we have to see it show up in the momentum. You can't trade the macro unless it shows up in the momentum. That's my base case. And it hasn't yet. Not the negative parts in the macro. The positive parts have. The semiconductor expansion, the earnings improvements that have happened all over that space, that part of the market rallying, that part of the macro is completely in the tape. The supply chain shortage, the energy crisis that we're having, that really hasn't shown up quite as much. And we'll see if, as time goes on, if that exacerbates how it may manifest. NASDAQ also has a very similar look, basically bullish above the 8-day. You know, we're already looking at a market that wants to grind higher, even in the face of hotter than expected year-over-year CPI. So it's pretty clear that there is some bullish momentum here. I wouldn't want to fade this thing below unless we get below the 8-day EMA. That's really the only place. For now, long and strong until we crack that. Gold futures, little less certain on this. I still do think we're going to make a nice move higher in gold. But I also am of the mind that as long as oil is well bid and long end rates are moving higher, gold is going to be under some pressure. So I'm actually more bullish on silver, copper, and platinum near term. I think silver is on the way to $100 an ounce this summer. Wouldn't be surprised to see that by July. And this is one where you can use the 21-day EMA as a momentum indicator. Above it, and typically you're going to see bullish extension. And West Texas Intermediate crude futures also looking bullish here, up 3% this morning. We're seeing a move above the EMA 21 over the last 2 days. This also has me looking at this more constructive. I like OIH as the play for West Texas Intermediate crude. My swing trade is the oil services because they're less sensitive to a drop in oil. They benefit from the crack spread. That's the spread between the price of oil and the distillates and things like gasoline, diesel fuel. And so at the end of the day, as long as there's more demand for refining, as long as there's more demand for oil services in the field, and in both cases there are, I think OIH has room to move higher. I look at some of the components like Schlumberger, and this has been one of our longs for a while as well. I think that also has room higher on a multi-year breakout. Bitcoin. Pretty surprised it's done as well as it has, because for the longest time it was neglected, it was hated, no one wanted to, go along it. The whole crypto space was essentially dead on social media. We have seen a bid. I don't think we're 100% out of the woods yet here, but I do like it above the EMA 21 for the potential for positive momentum to continue. Below it, and I think we could fade it right back to the lows around, let's say, 64,000 and lower. And with everything that's going on in the stock market, I always like to have a few funny comics or memes in here. I put this out there on Twitter. Some folks thought it was like a bearish comic. It's really not. It's just funny. Basically, the idea being, for those that don't immediately understand on its surface, if everything seems super duper easy, there might be some risk that's not being appreciated. And certainly given the sort of maniacal panic buying that we've seen in S&P options, semiconductors, and Mag 7 stocks, you could probably argue that there is a higher level of risk built into this because everyone's afraid of missing that upside. So again, we'd need a negative catalyst, but manage your risk accordingly in an environment that's this effervescent, that's this all on the long side of the boat. Now, quickly, let's look at options and some of these key levels in the S&P 500. I'm also going to share this on social, but these are the key options levels that my SPX options visualizer has identified for this week. Real quick, if anyone is interested in picking up a copy of Bookmap for up to 40% off, visit TraderAid.com/bookmap. And if you'd like to get up to 20% off TraderAid, visit our website at TraderAid.com. And at the checkout, use the code MAYHEM20 for 20% off your first billing period.